Welcome to the Thursday edition of the Tech Stocks Daily Podcast. Today we're diving into Snowflake's icy triumphs as it glides smoothly through Wall Street earnings, redefining data success with a snowy blitz. Then we'll unravel the drama surrounding AppLovin as it takes a nosedive under the microscope of short sellers and legal eagles. Up next, we'll investigate the turmoil hitting Manhattan associates as legal skirmishes over financial missteps unfold. Finally, we'll sift through the promising allure of PagSeguro Digital climbing the financial services hierarchy with strategic moves and compelling growth prospects. Stick around for all this and more in an episode chock full of tech revelations you won't want to miss. All right, folks, let's dive right into that dazzling snowball of data excitement known as Snowflake. Today, Snowflake Inc. found itself skipping and twirling in the tech news spotlight thanks to some impressive financial feats and a whole heap of investor optimism that's as contagious as a squirrel on caffeine. So, what exactly got everyone talking about this software giant today? Snowflake braved the icy waves of Wall Street by reporting stellar earnings for its fiscal fourth quarter of 2025, making even the biggest Broadway actors envious of its standing ovation. This data powerhouse did not merely meet expectations, it blew them out of the water like a high-speed snowblower on a blizzardy day. Earnings per share came in at a cool 30 cents, leaving analyst forecasts of 18 cents shivering back at the starting line. And if dollars are the notes that make up the wintry symphony of success, Snowflake's revenue was playing a full orchestra. The company reported fourth quarter revenues of $943.3 million, surpassing the consensus estimate of $914 million with majestic ease. The plot thickens knowing this revenue performance excelled amidst the usage-based pricing model, which, like folding a fitted sheet, isn't typically something that falls effortlessly into place. Speaking of excitement, you know it's serious when CFO Mike Scarpelli shows up in the news with a fist pump and a statement acknowledging customers who've outspent their contracts, a surefire sign of snowballing demand. Evidently, some users underestimated their needs, leading them to max out their booked capacity like someone discovering an all-you-can-eat buffet on a Monday morning. But earnings euphoria aside, part of the buzz is all about anticipation and forecasting. Snowflake daringly set product revenue expectations at $960 million for the first quarter and projected a 24% product revenue growth for fiscal 2026. It suggests the snowball of success, aka revenue, may mellow a bit in its certain accents. But hey, a glacier moving at its own solid pace ain't a bad thing either. Now let's not forget the surprising double act of growth expectations and AI innovation. The integration of OpenAI's models into Snowflake Cortex AI has analysts guessing like fortune tellers at a carnival. The prospects for AI-driven growth have investors scurrying to grab a share of the Snowflake pie, like chimpanzees scrambling for the last banana. Investors and analysts alike have perched Snowflake near its 52-week highs, and judging by their ratings, a snazzy strong buy, it's one hot commodity on Antarctica-esque spreadsheets. The resharpened focus on AI potential, burgeoning growth, and the serious investor confidence continues to give Snowflake that glowing glacial aura. To sum up, it's a great day for Snowflake. One where investor delight meets ambitious forecasts, a narrative of strategic growth that's as captivating as performing Shakespeare with kitchen utensils. Keep your eyes peeled. Snowflake might just sparkle like a diamond-encrusted snowman in the coming months. Hold on to your smartphones, tech fans, because AppLovin has just hit the headlines with all the subtlety of an AI trying to learn sarcasm. Shares of AppLovin Corporation, a leading platform for developers to boost their app marketing, and simultaneously your in-game ad views, took a nosedive yesterday, spiraling down by 12%, or a whopping $46.06 per share. All this just as investors were putting on their best smiles while watching the company's hip-hop-inspired app revolution, fueled by their somewhat enigmatic AI, AXON 2.0. But why the sudden tumble from grace? Two short seller research firms, those folks famous for throwing ice-cold analysis on business hype, dropped their own versions of investigative beatdowns, calling into question the very soul of AppLovin's prized AXON 2.0. Thus entered the Doom Squad, Fuzzy Panda Research and Culper Research, whose words seem more engineered to cause shareholders squirming than AppLovin's so-called AI could ever strategize. Fuzzy Panda's report contained a spicy hot pot of allegations, claiming that AppLovin's tech might involve some less than reputable practices, such as ad fraud and, wait for it, data sneakiness akin to stealing Meta's lunch. To say this report caused a stir in Silicon Valley would be like saying your Wi-Fi is a bit slow when it crashes during a critical online raid. On the flip side, Culper Research's work wasn't looking friendlier either. Their findings suggested that AXON 2.0 is more smoke and mirrors than actual tech wizardry, dubbing it nothing more than a promotional tool that dances around the company's genuine revenue streams, which they argue have little to do with AI at all. In response, our friends over at Hagens Berman, a firm keen on keeping corporate giants accountable, stepped into the ring ready to tear into the puzzle. They've started a full-on investigation, encouraging investors who watch their portfolios shrink faster than a frightened turtle to step forward and share their experiences. The firm is sniffing out any possible misconduct, specifically looking into whether AppLovin did some creative storytelling regarding how its revenue and shiny virtual hype train actually got moving. But wait, before you line up to applaud the end of AppLovin's fairy tale, there's another side to this turbulent coin. Despite its stock taking the corporate equivalent of a mud bath, analysts are still showing a little love to AppLovin, claiming the recent market turbulence doesn't completely obscure those glimmers of hope. Even with this financial roller coaster, the company has managed to impress with surprisingly good earnings and robust growth estimates for the upcoming years, making it an attractive if slightly nerdy stock pick for some long-term investors eyeing tech-savvy gains. So while AppLovin's AI magic show might be under fire, there's still plenty to gawk at in this unfolding drama. Whether this mysterious AXON 2.0 plot thickens or results in a classic comeback tale, one thing's sure, AppLovin isn't dropping the mic just yet. Today's hot buzz in the tech world swirls around Manhattan Associates, Inc., a global player in the realm of supply chain and inventory management software. Two law firms, Robbins LLP and the Portnoy law firm, have both taken center stage with class action lawsuits against Manhattan Associates over allegations surrounding misleading investor information, a juicy storyline capturing the hearts of tech aficionados and stock market sleuths alike. The heart of the issue emerges from accusations that Manhattan Associates misled its investors between October 22, 2024 and January 28, 2025. The crux of the lawsuit revolves around past communications from Manhattan Associates leadership, which allegedly painted a rosy picture of the company's fiscal growth potential, especially in professional services, and its ability to adapt or thrive despite economic fluctuations. But like an unexpected plot twist, it appears the reality might not have matched those glittering forecasts. In what looks like a reality check, when Manhattan Associates announced its financial results for the fourth quarter and full year of 2024, it also revealed reduced revenue guidance for 2025. The reasons for this downturn were chalked up to a shift of professional services work to future periods, less customization, and more significant partner utilization, a bombshell causing their stock price to nosedive more than 24%, from $295.10 per share on January 28th to $222.84 the following day. The revelation hit like a thunderclap, leaving investors with lighter wallets and heavier hearts, a classic episode of stocks gone wild. Now, shareholders looking to not just roll over and accept their fate, have an opportunity to join forces on a class action crusade. Both Robbins LLP and Portnoy law firm have put out a call to arms for investors to participate in their respective lawsuits. Robbins LLP is all about getting to the bottom of whether Manhattan Associates had, in fact, falsely projected its professional service capabilities, while the Portnoy law firm is ready to ride into a legal showdown, scrutinizing Manhattan Associates for possibly making not just misleading, but materially false statements to its investors. And what's in it for investors currently soaking in their bathtubs of regret? If you've held shares in Manhattan Associates throughout the appointed timeframe, you could potentially be in line for recouping some losses, music to an aggrieved shareholder's ears. While the deadline to step up as a lead plaintiff is April 28, 2025, the ball is notably now in the court of individual investors to decide whether to become part of the cast in this unfolding drama or sit spectator on the sidelines. Underscoring this saga is the essential take-home lesson for investors everywhere. Perform due diligence, ensure you're not buying into anything hotter than your portfolio's fire suppression system can handle, and always keep an eye out for sequel-worthy information releases that might suggest hitting pause before clicking buy. With this vivacious legal melee underway, grab some figurative popcorn and watch how the curtain closes on the first act of Manhattan Associates' latest turbulent performance. All right, tech enthusiasts, let's get into why PagSeguro Digital is making headlines today. PagSeguro, ticker symbol PAGS, is catching the financial world's attention with a wave of optimism surrounding its stock performance, and there are some solid reasons behind it. Firstly, PagSeguro is poised for potential growth, and the company's upward earnings estimate revisions are a key indicator of positive transformation. Analysts are collectively raising their earnings outlook for PagSeguro, aligning with a meaningful uptick in its consensus estimates for the upcoming quarters and the full year. The company's current earnings estimate sits at 29 cents per share, which marks a slight decline of 12.12% from last year. But when looking at the bigger picture, this actually means positive growth prospects. In a nutshell, the upward trend in consensus estimates and a Zacks rank of 2 makes PagSeguro a tempting portfolio addition. The icing on the cake, the stock's incredible 12.2% gain over the past 4 weeks, indicating strong investor confidence. Comparatively, PagSeguro is duking it out with dLocal in the financial transaction services sector to be the value investor's darling. Both companies are riding the Zacks rank number 2 wave, but when you lift the hood and look at classic value metrics, PagSeguro comes out on top. This is because PagSeguro currently boasts a forward PE ratio of 6.43, a PEG ratio of just 0.47, and a price-to-book ratio of 0.96. On the flip side, dLocal sits at a forward PE of 23.86, a PEG ratio of 3.26, and a considerably higher PB of 9.07. All told, PagSeguro sports a spiffy value grade of A, where dLocal manages a C. These numbers are compelling for anyone looking to identify undervalued stocks with strong potential for future performance. It's not to say dLocal is a slouch, it's just that by the numbers, PagSeguro appears to be offering more bang for your buck currently. Now it's your turn. What do you think about PagSeguro's performance and future prospects? If you've got thoughts, insights, or maybe you're ready to geek out over financial ratios, I'd love for you to drop your ideas in the comments. Your perspective, whether you're bullish or bearish, can add exciting depth to this ongoing stock saga. Looking forward to seeing your comments and insights below. All right, folks, let's spotlight Snowflake from today's tech buzz and break it down. Would we sell, buy, or hold? Given the promising news surrounding Snowflake right now, it looks like this glittering ice queen might be set to continue its sparkling run. With their recent earnings overshadowing expectations like a giant shadow puppet in a kid's carnival, Snowflake's soaring earnings per share and revenue figures have added a fresh layer of confidence for investors. Not only that, but their ambitious revenue projections and the integration of cutting-edge AI give this data platform an exciting edge. Snowflake's leadership is showing proactive movement not just with expansion projections, but by seizing on AI to further melt boundaries, something investors are eager to dig their mittens into. Analysts have their pom-poms out chanting, "Strong buy," which hints that there's more glitter where Snowflake came from, at least for the near term. The setup suggests further growth with gleeful forecasts filled with gap-beating potential and that metaphorical snowball effect when it comes to the company's financial performance. However, let's remember, an old tenet in the investing world is to keep an eye on the trajectory and not just the short-term weather report. Check market factors like valuation bits and revenue sustainability. While Snowflake looks like the hottest winter commodity right now, there are always those temperamental shifts to be cautious of, like market demand patterns and competitive advancements. So, current mood? Cheers to a... This snow ain't melting, folks, but it's always wise to bundle up and keep an eye out for any chilly headwinds. Lastly, always do your own deep dive into the data pool. Analyst notes, market trends, and your personal portfolio goals should guide your journey down snowy financial trails. Here's hoping your investment strategies dazzle brighter than a pair of crispy pants under twinkling mountain stars. I can't wait to hear your thoughts, so jump right into the comments and drop some wisdom or queries if you're up for it. In today's whirlwind of market activity, we've seen Snowflake Inc. dazzle with its stunning financial performance and AI-enhanced vision, proving it's got ice-cold moves in the tech world. Meanwhile, AppLovin took a tumble from grace, facing heated scrutiny while trying to balance on the AI tightrope. Over at Manhattan Associates, a legal showdown looms, sending ripples through investor waters, while PagSeguro gears up as a promising dark horse in financial transactions. Now, if you enjoyed our tech escapade through the highs and lows of today's NASDAQ movers and shakers, don't forget to smash that like button. Share this video with your fellow tech lovers and subscribe for your daily dose of tech news. Remember, every day is a new chapter in tech's epic saga, so be sure to tune in tomorrow for another round of sizzling updates. See you then.